Hey, good afternoon, everyone. This is Joe Bacella, webinar organizer here at Chaiken Analytics, and I'd like to welcome you to our presentation of how to protect yourself and profit in a market correction. Presenting today is Mark Chaikin, founder and CEO of Chaiken Analytics. As a reminder, this webinar is being recorded and a copy will be sent to everyone who has registered. Please submit your questions throughout the session via the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. Now, Mark Chaikin created Chaiken Analytics to put the power of proven stock research tools in the hands of professionals and individual investors. His latest contribution, the Chaiken Power Gauge Rating, is a proven 20-factor model that uniquely combines fundamentals and technicals. To get us started, here's Mark Chaikin.
Thank you, Joe, and welcome everybody. When we picked the title for this afternoon's webinar about a week and a half ago, thought that the market might peak sometime in early August, and in fact it has, based on the correction we saw in the market today. But take heart, because we've done about 3 of these webinars talking about market corrections over the last 3.5 years, and typically they come within 1 to 2% of a low. So we're a good contrary indicator in that regard. But we're really got a lot to talk about today, so let's get right to it. For those of you who don't know me, 50 years on Wall Street, lived through 10 bear markets. So I know the kind of pain and suffering that a bear market can bring. And because of that, I've been using technical analysis for 45 years, but always in conjunction with fundamentals. Combination of fundamental and technical analysis is extremely powerful. Along the way, I've been mentored by some of the smartest and most successful institutional investors. Some of them were colleagues and some of them were clients when we had an institutional brokerage firm. And everything that I learned from them is embodied in the Chaiken Power Gauge Rating, our multi-factor model that analyzes the fundamentals for you. It's the culmination of my life's work. It reflects what I've learned in 50 years on Wall Street, and we're going to share some of that knowledge, how to use it with a point of view of how to use it in a correction in this afternoon's webinar. So in the next 45 minutes, you'll learn how to protect your portfolio and profit in a correction. We'll show you how to find bears with the Chaiken Power Gauge and our proprietary relative strength indicator, how to use Chaiken Money Flow, which many of you know from your online brokerage platforms, to predict future price movement. I'm going to show you how to spot signs of an impending correction, how to identify weak sectors and industry groups so that you can play good defense, avoiding the landmines that can destroy a portfolio's performance. Now, I'd like to start off by asking you a question. Have you been thinking about a bear market? And Joe, why don't you put up a poll so we can get people's responses?
All right, so that poll is available right now. And if you don't mind, take a quick moment, go ahead and click your response in. Simply enough, what is your current view on the market? Are you bullish? Are you uncertain? Or are you bearish? We'll give you a few more seconds to respond. All right, close to 60% of responses. I'm going to give you a few more seconds, a few more trickling in. All right, we'll leave it there. And the results are, looks like mostly uncertain. Mark?
Well, this is interesting because we did a webinar on Tuesday and we only had 19% bearish. I think people are possibly being influenced by what we experienced today in the markets with the first 1% sell-off in the S&P in well over 3 months. So let's address the uncertainty and the bearishness head on by taking a look at the SPY, the largest, most actively traded instrument in the US markets, which mirrors the S&P 500. This is the SPDR ETF. We're looking at a 1-year chart, and you can see that we've been in a rising channel, but we ran into resistance at the upper end of that channel and our upper volatility band in the 2490, 2500 area. And with today's action, we've broken below the 21-day average, and we're heading down to the lower volatility band. But the uptrend, even this shorter term phase of the uptrend, is still intact. We are heading into support. We're fully oversold with today's action, and Chaiken money flow, which measures institutional buying and selling, is still very, very strong. It'll dip based on today's action when we look at the charts tomorrow. At the top of the screen is an important tool that we have at Chaiken Analytics to help you determine whether the market is healthy and likely to continue up or more vulnerable to a correction. We call this the power bar. For any index, ETF, industry group, we compute the number of stocks with a bullish Chaiken power gauge rating, and we're going to show you very clearly what that means in a few minutes, versus the number bearish. Now, heading into today, even though we made a new all-time intraday high on the S&P 500 just 2 days ago, we had more stocks with bearish Chaiken power gauge ratings, meaning that the fundamental potential was bearish than bullish. That's a negative for the market, and it's been rotating around that zero line in terms of bulls and bears based on the power gauge now for over a week. So it's the reason that we've been somewhat cautious on the market. That extends back over 3 weeks. Now, the next chart expands on that concept. As many of you know, the S&P 500 and the SPDR are what's known as capitalization weighted indexes. That means that the mega cap stocks like Apple, Amazon, Netflix, Google, Facebook, Microsoft have an outsized influence in the price performance of the index because they have the largest market caps of any stocks. In fact, those 6 stocks at one time in early June had contributed 40% of the gain in the S&P for the year. Now, what we're looking at here is another ETF, the Guggenheim Equal Weighted S&P. And what it's showing us when we look down here at our proprietary relative strength indicator, which measures the price performance of any traded instrument versus the S&P 500, is that the equal weighted S&P is underperforming the SPDRs or the cap weighted S&P. That means that the mega cap stocks are strong, but they're leaving the smaller stocks behind. That's not a healthy condition. And as you can see here, already broken the trend line down below the lower volatility band. This condition typically means that the market has a harder time breaking out on the upside and is more prone to corrections. And so we may be seeing the first 3+ to 6% correction that we've seen in a long time. We haven't had a 3% correction in the market since just before the election in November of 16, and we haven't had a 5% correction since Brexit, which was June of 2016. So let's put corrections, pullbacks, if you will, in perspective. What we're looking at here is a table that shows you the declines in the S&P 500 over the last 72 years, since 1945. There have been 75 declines of between 5 and 10%. That's what we typically call a pullback or a correction. They've averaged 6%, so they come about once a year. Typically, they last about a month, but most importantly, they recover the full loss and more in just a month. So corrections are actually your friend. They're not fun, but they give you an opportunity to put money to work. Now, 10 to 20% declines happen with much less frequency, about once every 3 years, 27 of them over 72 years. If you look at the bear markets, 20 to 40%, there are only 11 of them in 72 years. And that means if you're sitting there waiting for a bear market, parking cash on the sidelines, you're basically losing out on opportunities in the marketplace. It's better to view a 5 to 10% correction as an opportunity than the start of a bear market, because more often than not, that is the case. But let's say that you think that this August peak that we may have just seen may lead to some more selling in September. There's obviously geopolitical uncertainties and concern over North Korea and the whole nuclear verbal jousting that's going on. So there's a very simple but effective way to protect a portfolio or profit as a speculator from a decline in the market, and that's what we call a bearish vertical put spread. In this case, we're showing the spread from our options play module, which is a probabilities-based ideas module that we've integrated into Chaiken Analytics. And it's showing you that for $231, you can protect $24,000 because each option on 100 shares of the spider is equivalent to almost $25,000 worth of the market. But more importantly, you can profit almost 300% if the market just drops 3.5%. Now, I took this earlier this morning when the S&P was down 0.5%. So if the S&P were to drop from 246, where it was this morning, down to 237, which would be slightly less than a 3.5% decline, this vertical put spread, which doesn't expire until October 20th, so it gives you more than 2 months of protection, would yield a profit of almost 300% on a market move of 3.5%. So you can protect yourself and your portfolio or profit as a speculator on the downside. Now, a couple of days ago on Mad Money, I think it was Monday night, Jim Cramer talked about 5 rules for traders, anticipating that the market might be vulnerable. And I thought it'd be interesting to recap those 5 rules. He says you need to evaluate your stocks to see if they're meeting your expectations. To always have cash to put to work in the event of a sell-off. To never let a trade turn into an investment, that's absolutely critical. To worry more about your losers and not about your winners, and to focus on fundamentals, not hope. Now, I thought these 5 rules were really important because they feed into what we're going to be talking about in this webinar, but they also show you how much information you need to process in order to really stay on top of your trades or your investments. And that's one of the problems that we've identified in talking to clients over the last 4.5 years. Information overload. There's too much information in our personal lives with email and Twitter and Facebook and LinkedIn and Snap, Instagram. And then when you're trying to evaluate your investments, a la Jim Cramer's 5-point checklist, there's just so much information. So we created Chaiken Analytics as the antidote to information overload. It's our solution because what we do is consolidate a lot of information into actionable tools that enable you to evaluate the market and your investments very quickly. And because of that, we've gotten a lot of traction with professional investors like Soros Hedge Fund and Fidelity Investments and now Paulson Hedge Fund, and also with services like John Carter's Simpler Trading or John Malden's Malden Economics, and lots of press validating the Chaikin Power Gauge rating, validating our group approach in Barron's. Some interesting opportunities on CNBC, probably be on Squawk Box next week, perhaps on Tuesday, to talk about the Chaikin Power Gauge rating. Now, Chaiken Analytics helps take the sting out of corrections because it very quickly zeroes in on the most vulnerable stocks. And it does that by combining fundamentals with technicals into a multi-factor quantitative model, and then providing 6 pairs of buy and sell signals so that you can better time your exits and entries. Now, we've summed up what we think is a very disciplined and powerful methodology for successful trading and investing into this pyramid. The top of the pyramid, the Chaikin Power Gauge rating. That's central to everything we do, and we want to teach you why it works and try and have you come away from this webinar confident the Chaikin Power Gauge rating is a tool that can help you better manage your trading and your investing. We also like to look at industry group strength and weakness, but we do that in a unique way that we'll get into in the middle of the webinar. At the bottom of the pyramid, just 2 technical indicators, Chaikin money flow, which many of you are familiar with, and Chaikin relative strength, which really makes it easy to see whether a stock is outperforming or underperforming the market. And then in the middle, that sweet spot, the buy and sell signals. Now, I'd like to start out by showing you a pattern we call a classic Chaiken bull, because even in the midst of a correction, as Jim Cramer said, you should always have money to put to work in your favorite stocks. And our favorite stocks are classic Chaiken bulls. So a classic Chaiken bull is a stock where the multi-factor power gauge rating is bullish, indicating that the stock has the fundamental potential to do well in the market. Second point about a classic Chaiken bull is that it's outperforming the market. And then finally, Chaiken money flow is strong, indicating that the institutions are buying the stock, accumulating it, buying it on dips. And on the screen now is a one-year chart from Chaiken Analytics of Applied Materials, AMAT, semiconductor equipment manufacturer that's been leading the market higher. Power gauge rating has been bullish since $27 a year ago. It peaked around 47. And as you can see at the bottom of the screen, Chaiken power gauge rating, which is a ribbon that goes from red to yellow to green, has been bullish for almost a year. Right above that is Chaiken relative strength. It shows you that AMAT has been outperforming the market this whole time. So what does that mean? It means the market agrees with the model. The model is your directional edge, tells you whether a stock is likely to outperform or underperform, but the relative strength indicator tells you whether the market agrees with you. And that couldn't be more important, because no matter how good your fundamental research is, if the market doesn't agree with you, the market always wins. And then we see Chaiken money flow, which has been very strong, showing you that the institutions were accumulating AMAT. Then we see our buy and sell signals, in this case, our relative strength buy, which happens when a stock that's been outperforming the market dips below its 21-day average and rises back above it. And then a very special thing that we do in Chaiken Analytics, we color code the last 4 earnings reports, either red, gray, or green, to tell you whether a stock has outperformed or underperformed Wall Street estimates. And we're going to show you in a minute how important that is. So this is the classic Chaiken bull. We've made a double top here in AMAT. The power gauge has turned neutral, and we've had a really nice run. Now, in keeping with the theme of this webinar about managing corrections, let's look at a classic Chaiken bear. Power gauge rating is bearish, indicating that the fundamental potential for the stock is negative. Stock is underperforming the market, and Chaiken money flow is red, not green, telling you that the institutions are selling the stock, as they were here between September. Oh, I've got my flaky mouse back again. So this is your classic Chaiken bear. Under Armour was very much loved by the institutions, by the hedge funds in the low 40s. Power gauge rating turned bearish back in September a year ago. It's been underperforming the market for a year. These are the stocks you want to avoid. You want to be out of them when corrections are taking place. You don't want to be bottom fishing. So when you've got everything lined up on the downside, you're looking for shorting opportunities. And here we see these relative strength sell signals. Now, I love the relative strength signals for this reason. They have an accuracy of about 70%, and the time duration is 4 to 8 weeks. So traders can use them for swing trading or options trading, but investors can use them to enter positions or add to positions, or if you are looking for put buying opportunities, excellent opportunities. Now, knowing that there's a pattern is one thing. Finding the stocks that match that pattern is what's really critical. So we have a screener in Chaiken Analytics that enables you to screen on the power gauge rating, on some of the factors in the model. And what I've done here is to take the Russell 3000, look for stocks with a very bearish power gauge rating, and then one of the 20 factors in the model is earnings surprise. We're just in the middle or rather at the end of earnings season, and there have been a lot of stocks that have reported negative earnings surprises, and the market has been very unforgiving. This has been a very difficult earnings season. So I screened for stocks that had a weak earnings surprise factor in our model, where our two technical indicators, money flow and relative strength, are weak. And I'm looking at mid and large cap stocks. So we filtered a 3,000 stock universe down to 19 candidates, which are appropriate for put purchases if they rally up and get overbought, which shouldn't be in your portfolio, but should be viewed as an opportunity to raise cash. So we've created the environment by pulling everything together and then putting it into the screener. Now, I said earlier that central to everything we do at Chaikin is the power gauge rating. We output it as a gauge that goes from very bearish to very bullish. And it's a very simple looking gauge, but under the surface, there's a lot going on. It's very powerful under the surface, and it can be your GPS during earnings season, as we'll see at the end of the webinar. A lot of opportunity to make options bets that can pay off big during earnings season. And I call them bets because these are short-term option plays where the power gauge is your guide. Now, one of our partners, John Carter, who's an exceptional trader and has a trading room called Simpler Trading, got wind of the Chaikin power gauge rating about a year and a half ago and had his people do a deep dive. And he gave us this testimonial. He said, the power gauge rating looks like an objective, awesome meter for stocks. By combining 20 plus technical and fundamental factors to anticipate a stock's potential, it got my attention. And John has become a partner and a friend, and he sees the same thing that we see, that by combining technicals and fundamentals with some timing tools, you really have a complete package. So what are those 20 factors that got John so excited? Well, we divide them into 4 primary factors: financials, earnings, technicals, and expert opinion. And within each of those categories, we have 5 sub-factors. Now, financial metrics are the bedrock of the model, 35% of the model, with free cash flow to market cap and price to sales being the 2 most heavily weighted. And these are the factors that someone like a Warren Buffett, value investors, look at. They don't change very often, but there are factors within the model that are more sensitive. So earnings surprise is one of them. This is one of the things I learned from a mentor of mine, George Douglas at Drexel Burnham, who did the original research on earnings surprises and their impact in the market. And what George taught me was that earnings surprises come in bunches. There's never just one of them. And they lead analysts to raise or lower their estimates. And analyst estimate revisions are the single biggest short-term driver of stock price movement. So what we have here are longer-term value-oriented financial metrics, and then more sensitive shorter-term factors, including insider buying. Insider buying is really critical because when an insider takes out his checkbook and buys some more of his own stock, particularly in the small cap sector where they already own a big percentage of the company, they're making a big statement about what they see 12 to 18 months down the road as the potential for their own stock. And then finally, I've boxed industry group relative strength. We're going to be talking about that. People like Zacks, Standard & Poor's, Investors Business Daily have identified industry group relative strength as a very key factor in future stock price performance. Now, when you add all this up, you have an eclectic model that works, and it works because it's based on how Wall Street works. These are the factors that successful institutional investors look at every day before they make investment decisions. That's what I learned working with institutional investors, teaching them how to use technical analysis in conjunction with their fundamental disciplines. And the power gauge rating has been in the marketplace since January of 2011 in the form of research reports on 5,000 stocks, updated nightly. It's proven itself on the upside and the downside, as we'll see in a minute. And let's look at the performance, if you will, of the power gauge ratings using the Russell 3000 as a universe in 2016. The very bullish stocks in the Russell 3000 were up 32%. And each of these buckets is equally populated. The very bearish stocks up only 9.5%. So when you have a choice between a very bearish rated stock or a very bullish stock, you want to go with the very bullish stock because that's where the performance is. And in 2015, when energy stocks and small cap stocks in general were in a bear market, the very bearish stocks in the Russell 3000 in the Chaikin power gauge model down 17%. Very bullish stocks were basically flat, which is what the index did. So very important to avoid the bears, even in a bull market. Now, two other proof points, and then we're going to get on with some very, very powerful examples. We have two partnerships with very large financial institutions. With Nasdaq, starting in April of 14, we created 3 Nasdaq Chaiken indexes: large cap, small cap, and dividend achiever. These are indexes that are buy and hold for 12 months. The Nasdaq indexes upon which they're based get rebalanced once a year, and so do the Nasdaq Chaiken indexes. The goal was to create a track record and then have someone who creates exchange traded funds license these, and that's exactly what happened, because these 3 Nasdaq Chaiken indexes each outperformed their benchmark over the last 3 years since they were introduced on April 1st of 2014. And New York Life Insurance's Index IQ and Mainstay Investment Subsidiary licensed all 3 of them in February, registered them with the SEC, and the first exchange-traded fund based on the Nasdaq Chaiken indexes, the IQ Chaiken Small Cap Exchange-Traded Fund, was launched on May 22nd, has 160 million in assets. This is not meant to be a recommendation to buy the ETF. It's just validation of the power gauge methodology that we're talking about today. Now, I'd like to introduce 2 concepts that I think are really critical. The first one is what I consider to be the key to making and keeping profits, and that's spotting personality changes. Now, we define a personality change as a stock that's been outperforming the market, so our relative strength indicator is green, that starts to underperform the market. That's a bearish personality change. And this is really critical because too often we fall in love with our stocks and put our feet in cement and don't see the changing landscape, or we love to hate a stock and then we miss opportunities because we don't see a stock like Anthem Health, which prior to the presidential election was underperforming the market. No surprise there. There were a lot of concerns about a Hillary Clinton victory and how that might impact the healthcare stocks in a negative way. But right after the election, as the power gauge was turning bullish, Anthem Health broke this downtrend and started outperforming the market. We call that a bullish personality change. And now the market is agreeing with the model. And when you look at the Chaiken money flow, you see that the institutions were accumulating the stock every opportunity they could get. On the screen, we see our oversold buy signals. These are very simple. If the power gauge is bullish and the stock makes a new 8-day low, gets oversold, that's an oversold buy signal. And by the way, all 6 pairs of our buy and sell signals are explained on our website, whether you're a subscriber or a visitor. You can go there and see the rationale behind all these signals. And this signal is more of a trading signal. It lasts 5 to 10 trading days typically, but it's great for swing trading and options trading. And it's also a good spot to put money back to work in the type of corrective markets that we typically see, corrections of 3 to 5 to 6%. And you can see that this signal works about 2/3 of the time. And even in the midst of this sort of shaky healthcare debate, we got a lovely oversold buy signal just about 2 weeks ago, right after a positive earnings surprise. Now, you get a bearish personality change, and now you can play good defense and prepare yourself for a correction, because a stock like Tesoro Inc., the drug stock, is a poster child for a stock that you should be eliminating from your portfolio, where you're looking for put buying opportunities. When you see that bearish personality change and the power gauge negative, these are the stocks that you don't want to have to fuss with and worry about in the midst of a correction. And you see these overbought sell signals, 3 of them in the last 3 months, all good opportunities to get out of the stock. Notice that the stock, which is now in a downtrend, has had 4 negative earnings surprises in a row, including one just 3 days ago. And when you get a sell signal ahead of an earnings report in a stock that's underperforming the market, where money flow is coming out of it and the power gauge is bearish, you want to be looking for put buying opportunities, and you want to make sure that stock is not in your portfolio. Now, what's happening here is that analysts are now lowering their estimates on the stock. Remember, analyst estimates revisions, one of the 20 factors in the power gauge. Now, here's an example of a stock that had a bearish personality change in July of 2015. This chart ends in April of 2016 because SunEdison, one of the darlings of the solar energy business in that period, actually filed for bankruptcy. But the power gauge rating turned bearish in mid-July. The institutions were already selling the stock. This is a pattern we're going to show you in the next set of slides that has reliably predicted significant price declines over the past 30 years. And you had a bearish personality change. When you see that pattern, the stock was trading in the 25, 28 area. You want to get out of the stock and look for opportunities to buy put options. And look at all that institutional selling leading up to the bankruptcy filing. Now, hedge funds were bullish on this stock in the summer of 15. Merrill Lynch was recommending it. And at a trade show about a year ago, California, I was demoing our system, and I used SunEdison as an example. And a broker from Merrill Lynch, a financial advisor, came over to our booth and said, "Wait a minute, could you go back to that chart, please?" Which I did. And he said to me, "I bought SunEdison at 15 on the way down from 30 because my firm, Merrill Lynch, was still recommending the stock. If I had been using Chaiken, I would have saved myself and my clients a lot of pain and money." That's why these personality changes, particularly the bearish personality changes, are so important to know about. Now, the second pattern that I'd like to share with you is a secret sell signal that 95% of investors never see. We call it the Chaiken bearish money flow sell alert. And it happens because institutions like to fly under the radar screen. So what we're looking at here is a 1-year chart of Advanced Auto Parts. The power gauge rating was bullish, but then the stock had a positive earnings surprise, attracted some short covering and some Wall Street following, and traded up with money flow mildly positive. It then consolidated, and here in January of 2017, sorry about that, the stock equaled its old high, got up near the volatility band, and look what money flow was doing. Money flow was red, not green. It was telling you that the institutions were selling the stock under cover of strength. Could have been short covering, could have been the public buying it, but institutions, smart money, were getting out. We call that a money flow sell alert. When you see that, it's one of the rare opportunities in the market to get out of a stock before it starts to decline, with a high degree of confidence that you're not leaving a lot of money on the table. Now, after that money flow sell alert, you got a negative earnings surprise. Institutions were selling the stock, and then right before the latest earnings report, the stock rallied up to our upper volatility band and gave an overbought sell signal. And the company reported another negative earnings surprise. It's in the very weak auto parts group, as we'll see in a few minutes. And the stock spiked down from 147 all the way to 130 and kept going lower finally bottoming out at 100. So this whole methodology can help you in stocks that are correcting, even in a bull market that's been making new highs. Now, the opposite is true as well. When you see persistent accumulation, when the institutions are buying the dips so that money flow never goes below the zero line or negative, then you want to look for buying opportunities so you can buy along with them. In a webinar we did in February, KB Homes, which caters to first-time home buyers who are coming back into the marketplace. I love when reality gives me a good validation for the power gauge rating. First-time home buyers are back. They're coming out of their parents' basements. So reality is validating the power gauge rating, and the market now agrees with the model. So you had the opportunity to buy this at 16.5 on the way to 24. Any of these pullbacks where it got oversold or generated a buy signal, in this case we call this a money flow buy signal, when money flow is so strong, are wonderful opportunities to add to a position in your 401k plan or your investment account, or establish a swing trading position. This is another one of our short-term trading signals that typically last 5 to 10 trading sessions. So it's great for options traders. Now, what we've been talking about is something that Warren Buffett has spoken to. He's famously said that they don't call balls and strikes on Wall Street, so you don't have to swing at every pitch. You can wait for your pitch. He calls it the fat pitch. I call it the ideal setup. And the one thing that's missing from that ideal setup are the buy and the sell signals, the entry points. And we've looked at 3 different ones. We have 6 pairs of buy and sell alerts. But just as with the classic bears, you need to know when they're happening. So we have a dashboard. This is from our iPad app. We also have a dashboard in the desktop. And this is what I looked at coming into today. I have a list of about 150 stocks that I follow for webinars and the market letter. It's too many for an individual trader to follow, but it covers the waterfront for me. And when I came in this morning and opened the app, I saw the bullish alerts, the bullish signals, and the bearish signals. So there was an oversold buy signal on Boeing, which reported a very positive earnings surprise last week. And there was a relative strength sell signal on Bed Bath & Beyond. Now let's see what those charts look like. Boeing, as I said, has had a power gauge rating that's been bullish since April, been outperforming the market since October, and has a series of positive earnings surprises, culminating in the earnings surprise about a week and a half ago, where the stock spiked up from just under 210 all the way to 242. And now it's pulling back, and that new 8-day low coming into today is triggering what we call an oversold buy signal. You had one of them in May. And if you believed in this discipline, you could have bought Boeing after a 2-month consolidation on that oversold buy signal with very strong money flow. And the takeaway here is that any discipline based on proven analytics is better than trading on your emotions. So whether you're using candlestick patterns or your favorite chat room trading signals, or you're using Chaiken signals, following the discipline gives you the confidence to pull the trigger. Because once that buy signal appeared, the stock took off. And even today, with the market down 1.5%, Boeing, which was up a little bit when I did this chart this morning, finished down just a small fraction. The institutions are still buying this stock. They're going to buy the dips. Aerospace defense, getting big contracts. It's a bullish stock. Now, on the downside, Bed Bath & Beyond has been in a downtrend, underperforming the market since late December. And look at that institutional selling. If you had the choice between buying Boeing or Bed Bath & Beyond, which would you choose based on the money flow and the relative strength? Can you see how important the technicals are, particularly when they are confirmed by the fundamental model? Now, what we had today was that relative strength sell signal. Remember, I said they work about 70% of the time. In this case, every one of the signals worked on this chart. And they typically have a 4 to 8 week time horizon. So they're perfect for put buying. Now, here's a stock that recently made a new 52-week low. At the close today, it was down 4.5%. Earlier, when I did the chart, it was down 2.8%. If we get that 3 to 6% correction, and we're a third of the way there right now, down 2% plus from the highs just made 2 days ago, this stock will almost certainly make a new low. Meaning that if you had bought a put spread on the opening today, you're likely to see very nice profits over the short term. Now, when I showed you the pyramid, I talked about how group strength and weakness is so important. We like to look at the select spider sector ETFs to figure out where the sector trends are, and then look at industry group strength or weakness, because strong sectors and groups, if you focus on them from the long side, give you a tailwind. They help generate bigger long profits, whereas weak sectors and industry groups, as you'll see in a moment, create headwinds which make it difficult to profit on the long side, but quite easy to make money on the short side. So the first thing we like to do is rank sector ETFs so we can find the losing sectors and avoid them. And most people look at price momentum when they're looking at sectors or industry groups. We have a unique way of looking at it. That's the power bar that we were looking at on the spider. It tells you the number of bullish versus bearish power gauge stocks in any of these 10 select spider sector ETFs, which basically carve up the S&P 500 into 10 sectors. Right now, there are 4 sectors: utilities, healthcare, financial, and technology, with power bars that are positive and stronger than the S&P. And at the bottom of the list is energy, where there are no stocks in the large cap energy sector with bullish power gauge ratings. And that's been the case for the last 4 months. So these trends persist over time. Let's just take a look at the XLK, the select spider technology sector ETF. You can see the relative strength is bullish. It's green. And you can see that money has been flowing into this ETF. A lot of institutional investors and advisors allocate client assets using these. A lot of individual traders use them when they don't want to pick a particular technology stock, especially during earnings season. But you can see that there was plenty of opportunity to buy the sector ETF or buy the best ranked stocks in the ETF on the dips that we've seen back in March and April, and then again in June and July. So sector trends persist, and if you're aware of them, and we give you a very easy way to know that, you can skew your trading positively toward technology, negatively toward energy, the way they're lined up right now. Now, I like to drill down and get more granular because industry groups give you a lot of opportunities. So we rank 65 industry groups created for us by Zacks Investment Research by the power bar. And on the left are the very bullish industry groups. The one with the most constituents is aerospace defense, 20 bullish stocks, 1 bearish. This was true even before the rhetoric about the Korean nuclear threat escalated. Lockheed Martin has been strong. Boeing, obviously. L3 and so forth. And then apparel has been strong, reversing a trend that's been in place for about 7 or 8 months. Now, why did apparel get strong? It got strong because Congress took a border tax off the table. The apparel stocks were hurting because they were fearful that a border tax would be part of any tax cut strategy or budget strategy. Congress took that off the table, and apparel stocks, as we'll see in a minute, did quite well. Now, the very bearish sectors are dominated by the energy complex. So bearish industry groups break down the energy sector, the XLE, Select Spider Sector ETF, into 4 different categories, and each of those categories is bearish. So very easy to find bearish stocks to trade on the downside. Now, how do I find stocks to recommend in my weekly market letter that we call Market Insights? Well, I do a top-down analysis. I look at the sectors and the industry groups, and then I try and find, if I'm bullish, the best stocks in that industry group. So in my weekly market commentary on March 9th, it was actually a Sunday, there's a typo there, I saw that the apparel group had moved up in the rankings. It had peaked in November of 16, just after the Trump victory, on fears of the border tax or a trade war. But then Barron's wrote it up that Sunday and talked about the group turning around, and I could validate that with our industry group power bar rankings. So I culled 4 apparel stocks with bullish Chaiken power gauge ratings and advised buying them on pullbacks of 1 to 3 days. So let's look at 2 of them. PVH, which was at 112, and Michael Kors, which was at 36. PVH was trading at about 112 when I put out that recommendation. It barely downticked and went straight up to 125, where it peaked 2 days ago, and now it's pulling back a bit in this mini correction. Notice that you had a bullish personality change just around the time that they took the border tax off the table. Now, Michael Kors gave you a really good opportunity because it did dip, and notice that the money flow stayed green or positive on the dip. And that came ahead of an earnings report, which came out 3 days ago, in which Michael Kors exceeded Wall Street estimates. There's your positive earnings surprise. Analysts are now raising their estimates. This is the 4th positive earnings surprise in a row. The fear of a border tax is off the table. And Michael Kors spiked up from 37 all the way to 45, and now it's pulling back. So part of what you do in a correction, especially if you think that we're not heading into a bear market, and I don't think we are, because earnings in the second quarter were very strong and company guidance was very strong as well, is look for stocks to buy. That's Jim Cramer's idea of putting cash to work in stocks that you like on a correction, taking advantage, or as Warren Buffett would say, be greedy when people are fearful and fearful when people are greedy. So there's going to be a buying opportunity here in Michael Kors. The institutions are still buying the stock. There are plenty of shorts that need a cover, and corrections are a way that you can buy into a stock that's been very strong, where you don't want to buy it on a spike up. Now, on the downside, back in April, I identified the auto parts retailers based on the industry group rankings as weak, and identified 3 auto parts retailers to sell on strength. This is part of how you avoid pain and suffering in a correction, by getting out of these stocks before they start correcting. So Advanced Auto Parts, we already saw that bearish money flow sell alert at 170, AutoZone and O'Reilly Auto. And in this case, I said, all of these stocks are at or near 52-week lows. Sell them on rallies of 2 to 4%. I don't like selling into a hole. So I don't like selling stocks at new 52-week lows if I can avoid it. And we see on this chart of Advanced Auto Parts that it did rally a little over 4% into an earnings report where they surprised on the downside. We got that sell signal we showed you before, right ahead of a negative earnings surprise, and the stock ultimately went from 150 to 100. Now, O'Reilly gave you a wonderful opportunity. This is where we said sell it on a bounce. It bounced up again right ahead of earnings reports. You see how important earnings season is. If you know what you're doing and you have tools that you can rely on, could have sold that stock, negative earnings surprise. The stock drops from about 265 all the way down to 210, 220, and then the company announced June same-store sales down 4.4% year over year, and analysts had been looking for a 12% increase in earnings for O'Reilly for the year 2017. Well, you can't get a 2017 boost of 12% when your year over year sales are down 4.4%. So O'Reilly took a tumble and dropped all the way from 215 down to 170, where it finally bottomed out. But if you had followed the Chaikin methodology, you could have been out of the stock buying put options at 260 on the way to 170 less than 3 months later. And AutoZone gave you a similar opportunity, negative earnings surprise. Then after that negative earnings surprise, you got a money flow sell signal at about 600, and the stock has bottomed out here at about 590. Tremendous opportunities if you identify the sector and industry group trends, look at the power gauge, the relative strength, and the money flow. Notice how the institutions have been selling this stock. Can you see the flow of institutional money in and out of a stock? In this case, they're selling AutoZone for over a year, with the stock dropping from 800 all the way to 490. These tools have been used by institutional investors for over 30 years. Money flow has been in every software package since the early 80s. You can use them too. But they're available on stockcharts.com. You don't have to subscribe to Chaikin, but what we do is combine that powerful 20-factor quantitative model that does the fundamental heavy lifting. It's the answer to Jim Cramer's point that you've got to monitor your investments and pay more attention to fundamentals than hope. Now, let's talk about playing good defense, because that's really how you manage a correction and actually profit from it, because you can turn lemons into lemonade. So how do you play good defense? Well, Herb Greenberg, who writes for TheStreet.com and is on CNBC, took about a 2-year hiatus to focus on short ideas for hedge funds, but he's back on TV. Before he left in January of 14, he wrote a column saying it's the stocks that you don't own that matter. Now, what he meant by that was, if you know what stocks to avoid, you're going to put the odds in your favor. So you can reduce risk by avoiding mistakes, by avoiding weak industry groups, by knowing what stocks not to buy, and you can improve your performance by eliminating potential losers from your portfolio. And finally, you can use put options to protect your portfolio. So let's take a look at what a bear market looks like as it's unfolding. We often get the question, because we launched Chaiken Analytics in January 2011. We've been in a bull market for 8.5 years. What happens in a bear market? Well, Chaiken and this whole discipline methodology helped me in a bear market. Well, what you see on the screen here is an idealized chart developed by a market strategist named Richard Wyckoff over 90 years ago. How many of you are familiar with Richard Wyckoff? If you are, type a big W into the chat box, please. Well, that's good. I see a number of you are familiar with Wyckoff. Over 90 years ago, he developed this chart. The patterns exist today. And the reason is human nature hasn't changed, and stock market price movements are a reflection of fear and greed and human emotions taking markets to extremes on both short and intermediate and long-term basis. So this is what a bear market looks like, but we've been in a bull market since March of 2009, except in the energy sector. So this is a 5-year chart of the XLE, the Select Spider Sector Energy ETF. Remember, no bullish stocks in there right now, but back in July, August, and September of 2014, energy stocks were powerful. The XLE got up to 100. And then in September of 2014, you had a bearish personality change, and the XLE proceeded to drop 50%, from 100 to 50 in about 18 months. Now, along the way, stocks like Schlumberger and Range Resources and Pioneer Development, the fracking stocks, offshore drilling stocks, turned bearish. One stock that sort of levitated and held up for another 6 months was Kinder Morgan. They did a sort of financial engineering by rolling up the master limited partnerships that they had floated into the parent company, and Wall Street loved the 20% yield on the stock, thinking they would never cut it. Well, they did cut it, and when Kinder Morgan finally peaked at around 42, it had not a 50% decline, but almost an 80% decline, bottoming out around $10 a share when the damage was already done. And you had a bearish personality change along the way. Let's look at what Kinder Morgan looked like on a 1-year chart. That was a 5-year chart along the way. This chart begins in early 2015 when the energy sector was already bearish. Kinder Morgan saw the power gauge turn bearish in May of 15 with the stock at about 40. And you had a bearish personality change when relative strength went from green to red. The institutions then started selling the stock, and along the way, you got these periodic rallies. In this case, our overbought sell signals popped up on a new 8-day high. And even though the stock was down from 40 to 30, it wasn't too late to sell it. It's never too late to sell a stock where everything is lined up against it, because ultimately this stock bottomed out at $10. Now, let's take a look at the XLE today. This is the 1-year chart that's current through today's trading. You had a bearish personality change in January. That means that the large cap energy sector was rolling over. And institutions started selling, and the XLE dropped from about 74 to about 64. So you had a 15% decline in large cap energy stocks at a time that the S&P 500 was making new all-time highs. Small cap energy stocks dropped 25 to 30%. So when you have a situation where a sector is underperforming the market and our power bars are weak, telling you that there are no bullish or very few bullish stocks, you want to look for stocks like Schlumberger. Get them out of your portfolio, put them on your bear list, looking for opportunities to buy put options or sell short. And you got a wonderful overbought sell signal in March. That's 2 months after the sector turned bearish, about a week ahead of earnings reports. Negative earnings surprise, the stock drops. That sell signal came at around 78. The stock bottomed out at 64. So even in a bull market, there are opportunities as stocks correct and group rotation favors the strong and takes money away from the weak. Now, just recently, Pioneer Natural Resources, PXD, which is one of the fracking stocks in the Permian Basin, triggered a sell signal. It was down from 195 to 160. And ahead of this most recent earnings report, you got an overbought sell signal. Great opportunity to get out of the stock if you were stuck in it or buy put options. And what happened? The stock dropped from 162 after a negative earnings surprise all the way to 130. These patterns repeat over and over again. Can you see the patterns just popping out at you? Because when you look at stocks through the lens of the power gauge and these two technical indicators, you really start to see things very clearly. Now, playing good defense also means knowing when to sell. And selling is an art, not a science. But there are tip-offs. We saw the bearish money flow sell alert. This is a variant on that. Here's a stock called Seles. We recommended it back in April as one of 2 small cap semiconductors to buy. And the stock had a beautiful run. It went from 18 to 26, but the power gauge has been bullish starting at $12 a year ago. And along the way, money flow kept confirming the peaks, but something very telling happened here about 3 weeks ago. With the market making new highs and the technology sector having a short-term correction, the Seles sold down from 26 to 20 and then rallied up to 23. It got overbought, but look at Chaiken money flow. Red, not green. So 2 bearish things happened here. One of them is that the stock failed to make a new high when the technology sector was making a new high. That's a bearish price divergence. And then money flow showed you that the institutions or smart money was getting out of this stock. So if you had bought it along the way and were a long-term investor, this is a sign that you should take your money off the table. Certainly, if you bought it on that oversold buy signal, you want to take your profits. And you don't want to overstay your welcome in a stock that's already gone from 12 to 26. It gives you the chance to get out at 23 with very nice profits. Now, the next time they report earnings will be on November 1st. Analysts are still raising their estimates, but we're out of this stock looking for new names, new opportunities. Now, we have something in Chaiken Analytics that we call our power grid. It's part of our portfolio health check. Just think back to what Jim Cramer advised in those 5 points. Monitor your portfolio. Make sure your stocks are meeting your expectations. Well, that's a lot of work, especially if you have a lot of stocks you're following. The power grid can be your defensive coordinator. It does this by analyzing stocks in 3 dimensions, looking for strong stocks in strong industry groups, and those go in the upper right. So those stocks are just fine. This chart is actually about 4 years old. We created it for our documentation for the Chaiken Analytics product. And in the lower left are weak stocks in weak industry groups, and they're the ones you should be worrying about. Remember, analyze the fundamentals. Don't just go on hope. So this power grid is an important part of Chaiken Analytics. We're actually moving it up, giving it its own tab because it's so powerful. And in the click of a button, you can immediately see which stocks you're following are vulnerable and which ones you want to be trading on the upside. Now, I'd like to end the webinar with something near and dear to my heart, winning plays during earnings season, because whether you're in a correction or a roaring bull market, huge opportunities on the long and the short side during earnings season. But only if you have something like the Chaiken Power Gauge as your guide. So every week in Market Insights on Sunday, we highlight the stocks that are due to report earnings in the following week. So on July 24th, we had this little earnings calendar, but we add something to a conventional earnings calendar. We tell you whether the power gauge is bullish or bearish, because a stock with a bearish power gauge rating is twice as likely to report a negative earnings surprise. And a stock like Boeing, which we've already seen with a bullish power gauge rating, is more likely to report a positive earnings surprise. So we've identified 3 or 4 stocks here that I want to show you quickly as we end the webinar. Seagate, STX, Chipotle, Starbucks, and Helmerich & Payne in that very bearish energy sector. Well, Helmerich & Payne gave you an opportunity right after that Market Insights to sell the stock ahead of that earnings report. And it did exactly what it did 3 months earlier in April, where we identified it as a bearish stock due to report earnings. There, it dropped from 66 all the way to 50. Having rallied to 56, another negative earnings surprise or a negative reaction to their earnings, and the stock dropped from 56, making a new 52-week low at 46. So patterns repeat over and over again, lots of opportunities during earnings season. Seagate, where the power gauge had recently turned bearish and you had a negative personality change, gave us a sell signal, a money flow sell, just 5 days before they reported earnings about 2 weeks ago. The stock disappointed and dropped from 39 all the way down to 32, about an 18% downside gap. You could have captured that with a put spread, very limited risk. You know what your risk is, it's the cost of the put. But if you're playing good defense, this is how you manage corrections, because you're out of stocks like this or short stocks like this using puts as a low risk way to establish those positions. So let's end the webinar by showing you our newest innovation in Chaiken Analytics. At the Benzinga FinTech Awards, and Benzinga has been sponsoring these for the last 3 years. In May, we won the award for Best Ideas Platform in a category with 19 other services. Very proud of that. Benzinga has been a good source of cutting edge financial technology tools. And the reason we won that award was because of our stock discovery engine, recently added to Chaiken Analytics in the last 4 months. The stock discovery engine helps you find profitable ideas quickly and reliably. It functions the same way that Spotify finds you music that you're going to like, or Netflix finds you movies, or Amazon finds you just about everything else in life. And for a webinar that I did on May 25th, 2.5 months ago, I seeded the stock discovery engine with Advanced Auto Parts. We've already seen how bearish Advanced Auto Parts was. It was 133 on its way to 100, down 5% that day. And the stock discovery engine instantly found match large cap retailers, bearish earnings estimate trends at or near their lows. And there's AutoZone and OReilly at 240, which was on its way to 170. Macy's, which reported negative earnings before the opening today and was down 10%. And it also suggested a potential swap. If you wanted to stay in the retail sector, I zeroed in on Best Buy because this is one of the few bricks and mortar retailers that's beaten back the Amazon challenge. So let's see what happened there. Well, here's what Best Buy looked like when I highlighted it as a buying opportunity ahead of earnings at that May webinar. The stock was trading around 50. It had just given an oversold buy signal. You had a positive earnings surprise. The stock spiked up from 50 to above 60. So a put trade was very profitable, as we'll see on the next slide. And then it pulled back all the way to 55, gave you an oversold buy signal, another opportunity to get in. You had a nice trade to the upper band. And then the stock got spooked because Amazon announced their own version of the Geek Squad, and everybody is spooked by Amazon. There was your bearish money flow sell alert, by the way, so you knew to get out of that long trade. But this stock has such powerful fundamentals that it's making new highs again. Pulling back with the market will give us another buying opportunity. Now, we got this testimonial from a new Chaiken subscriber. He said 257% in 24 hours on earnings. Gave options one more try. I was surprised with the results. I don't think I would have ever attempted an earnings trade without the guidance in your webinars. And this is from a very new Chaiken subscriber. Now, one more example of the discovery engine. In my weekly market letter in late July, I made Starbucks my bearish stock of the week. They were due to report earnings on Thursday. These letters are written on Sunday. So I entered Starbucks into the discovery engine, and it immediately gave me other food retailers with bearish power gauge ratings. The first one, the most close as a match to Starbucks, was Chipotle with a very bearish rating, trading at $3.95. So let's see what happened to those two stocks. Well, Starbucks reported a negative earnings surprise and dropped from 58 all the way down to 54. It's making a new 6-month low today, and the stock really can't get out of its own way. The institutions are selling it. But the results in Chipotle were even more dramatic. But let's step back. Here's that money flow sell alert. You make a new high in the stock and look at Chaiken money flow. It's red, not green. Apologize for that. The Apple mouse is very sensitive. But if you didn't sell it up there at 490, you saw the bearish personality change take place at about 460. Institutions just selling the stock. And then where that red arrow is, unfortunately, E. coli resurfaced in some of their stores, and the stock took an immediate tumble of 50 points from 400 down to 350, then gave you an earnings report that people really didn't like, and the stock is now continuing to make new 52-week lows, traded down over 3% today to 325. So these patterns repeat over and over again, and you can find them with Chaiken Analytics and the Discovery Engine quickly and easily. So now you know how to protect and profit in a correction. And everything we've looked at is in Chaiken Analytics, which is a proven stock selection system, which at its core has the Chaiken Power Gauge rating. That's what differentiates this from other products that have technical charts earnings information, news. No other product has a powerful 20-factor model that combines fundamentals and technicals into a easy to understand rating. And now we have our stock discovery engine to find new ideas quickly and easily. In addition, we've seen the screener and our options ideas capability. And all of this retails for $1,950 for a one-year subscription to Chaiken Analytics. You can go to our website, chaikenanalytics.com/correction. And when you do, you'll see that we have discounted the price by $200 as a webinar special down to $1,750 for an annual subscription. This offer expires Sunday, August 13th. chaikenanalytics.com/correction. Now, in addition to everything we've just showed you, we have intraday charts with alerts, earnings detail and alerts, and my weekly market insights where you get some of the ideas we've talked about. Plus, as a Chaiken subscriber, small group tutorials to help you get set up. So like Fraser, you can make profitable options trades quickly once you know the features and the benefits of Chaiken Analytics. You get unlimited coaching from Joe Bacella and customer success team, support when you need it, and one-on-one coaching, absolutely critical. If you need one-on-one coaching in either the options or the stock area, we make it available to you at no additional cost. And my colleague John Schlitz's daily morning insights. Now, Ken H. was a new Chaiken subscriber on January 4th. He's been getting one-on-one coaching, and he gave us this testimonial on July 30th. From $235,000 to $1,205,000 in 7 months. I've been trading stock options for many years with not much success. On January 4th of 17, I found your system. I started the year with $235,000. As of today, my net liquidation value is $1,205,000. I would not have been able to achieve this without your system. And Ken H. has been getting one-on-one coaching. I think he's ready to fly on his own. I sure wish my account was up that much this year, and I imagine many of you would like to see that kind of success. So to make it as comfortable as possible to subscribe to Chaiken Analytics, as a fast action bonus, I'd like to take $300 off the list price of $1,950, reducing it to $1,650. And for the first 10 people who subscribe tonight, you'll get a 30-minute one-on-one call with me if you subscribe by midnight tonight. Now, I'm going to be on the road for the next 6 weeks or so. So this is the last time we're going to make this one-on-one offer until November or December, because I've got a really full schedule and I like to fulfill my commitments. So if you subscribe by midnight tonight, $300 off, $1,650, plus the first 10 people who subscribe get a 30-minute one-on-one phone call with me. We can schedule that before I go on the road in mid-September. So with that, I'd like to thank you for staying with us. I hope that correction treats you well, and we've given you some tools to handle that correction. And with that, I turn it over to Joe Bacella to wrap up the webinar.
All right, great. Thank you so much, Mark. And thank you, everybody, for joining us today. Remember, this is an offer for a full year's worth of access to Chaiken Analytics, $1,650 for a complete year, plus take advantage of that one-on-one offer. I can tell you, having worked with Mark for the past 2.5 years, that his guidance has been invaluable. So it has absolutely been a fantastic experience to work with him. So I'd love for each of you to share that experience as well. I would also love for you to join us for our onboard session. I just saw a few questions regarding any kind of support or training that we provide. We offer sessions each day. An onboard session is really the best way to get started, and we are hosting one tomorrow at 2 o'clock Eastern. We're recording that session for you as well. So maybe if you're not available for tomorrow on short notice, we'll make sure that you can access the recording of those sessions. But again, the offer link is available. What you're seeing on the screen right now is the order page for you to take advantage of this. I chatted out the link to everybody, plus a phone number, 877-697-6783 is also a great way to get in touch with us. We also have a number available, 877-978-6257. Both numbers will work for you. But in either case, we'd love for you to take us up on this offer. In the meantime, everybody, have a wonderful evening. Thanks for joining us, and we will see you on tomorrow's onboard session.